Enron looked like the future. A company that didn't just sell energy, it sold ideas. Markets as elegant machines, risk as an art form, numbers that flowed upward like a tide. Reporters called them visionaries. Analysts called them a buy. Inside glimmering towers in Houston, the smartest guys in the room smiled politely when people asked the wrong questions. And then, in a single season, it all turned to dust. To understand Enron, start with the promise. The American energy business had always felt old. Pipes in the ground, smokestacks, regulated rates. Enron wanted to turn it into software. Prices would be digitized, risk would be sliced and traded, and the company would sit at the center like a platform, taking a cut as the world learned to think in futures and options. Electricity and natural gas would trade like money, and Enron would be the bank. In the 1990s, this story was irresistible. Deregulation swept through energy markets. Technology promised speed. Wall Street rewarded innovation with a premium. Kenneth Lay, the statesman's CEO, could glide through Washington, ease doors open, and speak the language of policy. Jeffrey Skilling, razor-sharp and intense, had the spark of a missionary. Energy could be a chessboard if you were smart enough. Andrew Fastow, the finance chief with the cool demeanor, knew how to make complicated problems disappear. Each man in his way built a culture that celebrated intelligence and confused it with wisdom. From the outside, the numbers shimmered. Revenues exploded. Enron's market value rocketed. They were on magazine covers, on stage at conferences, in rooms where the future was negotiated. The message was precise. We don't just sell kilowatts, we create markets. And in markets, growth is limited only by imagination. Inside, the incentives were equally precise. Enron paid for deals, not for profits. If you could structure something that looked good today, the company could book the gains today immediately as if the cash had already arrived. Mark-to-market accounting, once a tool for traders, became a permission slip for storytelling. Ink the contract, estimate the lifetime profit, record it now. Next quarter, do it again. Each period, a new act in a play whose ending no one dared to write. The trick worked because it had the sheen of sophistication. The company's energy traders on glass-walled floors buzzing with screens looked like the future of capitalism. They struck complex agreements with utilities, municipalities, even broadband hopefuls. A pipeline deal in South America, a power plant hedged with derivatives, a broadband capacity trade that sounded like telecom magic. The world nodded along. Enron was a platform. Enron was a market. Enron was math. But the math had a flaw. If today's profits are tomorrow's hopes, you need tomorrow to play along. Deals must keep coming. Assumptions must keep holding. And any loss, any delay, any cash shortfall needs to be pushed off stage. That's where Andrew Fastow's gift became essential. He understood that you could move a problem if you found the right box to hide it in. Special entities, shells created off the balance sheet, became the boxes. With friendly banks and investors, Enron could transfer assets into these structures, take in cash, and keep debt from showing up where it would alarm shareholders. Names like LJM and the Raptors sounded like inside jokes. Their purpose was serious. They absorbed risks that might otherwise force Enron to admit reality. They could even manufacture a kind of mirror. If an asset lost value, a complicated arrangement inside a special entity could pretend to catch the falling knife. From quarter to quarter, the machine hummed. Mark new profits. Bury old problems. Praise the star dealmakers. Repeat. A company allergic to volatility created the illusion of smooth ascent. Meanwhile, pressure leaked into the culture. Young employees learned that asking why was dangerous. Skepticism read as disloyalty. The joke in the elevators was that Enron hired the best and brightest and then taught them to be arrogant. arrogance made it easier to ignore the smell. In 2000 and 2001, the illusion stretched too far. In California, the promise of deregulated electricity met reality. Thin supply, market rules that could be gamed, and traders who saw opportunity. Rolling blackouts darkened cities. On recorded phone calls, some traders laughed in a language of inside baseball and gallows humor. Evidence that, far from stabilizing markets, Enron's brainpower had learned to bend them. National headlines followed. Suddenly, the company that sold control looked chaotic. At the same time, Enron's big bets outside its core, ventures in broadband and overseas projects, sputtered. Deals that had produced handsome paper profits weren't sending real cash. The boxes off the balance sheet, designed to catch losses, relied on Enron's rising stock to keep their own promises alive. As the share price softened, those safety nets tore. What had been hidden at the periphery began to drift into view. In August 2001, Jeffrey Skilling, the architect of Enron's trading engine, resigned abruptly, citing personal reasons. Inside the company, people felt the air shift. If the strategist was leaving, what did he know that others didn't? Sharon Watkins, a mid-level executive with a talent for pattern recognition, had already noticed a design that didn't make sense. Entities that seemed too closely tied to the company and an accounting structure that assumed the sun would always shine. She wrote a memo that moved quietly upward. I am incredibly nervous that we will implode in a wave of accounting scandals. It was the kind of sentence that sounds hysterical until it is obvious. As questions spread, so did the need for answers that could withstand daylight. Enron reassured investors. It pointed to its revenue growth, to its innovations, to the credibility of its auditors. Arthur Andersen, one of the most prestigious accounting firms in the world, had its name on Enron's books. But prestige, like stock prices, can slide. When investigators began asking for documents, the shredders at Andersen spun. Whatever the intention, the effect was damning. A firm that had certified Enron's story was now erasing the margins. Public trust snapped. Andersen would not survive the year. By the fall of 2001, Enron needed what its storytelling had never demanded: cash. Lenders tightened, counterparties hesitated, and the special entities designed to swallow risk began to spit it back up. On conference calls, analysts asked questions that no longer felt rude. Why were so many crucial structures dependent on Enron's own stock? Why did so little cash flow from so much reported profit? Why did the math only work in the dark? The company tried to turn the page with a large write-down. It promised transparency. But one admission invites another. As the stock sank, more problems breached the surface. Ratings agencies that had blessed Enron's complexity revised their opinions. Suddenly, debt that had been tucked away demanded attention. When a business that trades on confidence loses it, balance sheets accelerate toward the truth. Banks asked for more collateral. Trading partners asked for more comfort. Employees watched their retirement accounts, heavy with Enron shares, erode in real time. On December 2, 2001, Enron filed for bankruptcy. In pure scale, it was historic. At that time, the largest corporate bankruptcy America had ever seen. For employees who had believed the story, it was a personal disaster. Jobs gone, savings decimated, a sense of identity ripped away. For investors, it was a lesson in complexity as camouflage. For policymakers, a reminder that innovation without guardrails invites the worst kind of creativity. In the quiet that followed, details emerged like footprints in wet concrete. Mark-to-market accounting had become a license to harvest future dreams as present profits. Special entities had been used not as tools of risk management, but as optical devices that made debt disappear and losses look contained. Executives who were paid to produce steady growth had stacked assumptions on assumptions and called it mastery. The auditors, entangled and conflicted, had been too close to see or too invested to object. Across the river of credit that feeds modern corporations, gatekeepers looked up from their work to find that they had mistaken motion for progress. If the story ended here, it would be a cautionary tale about hubris. But Enron is also a study in how numbers become theater. A company can manage perception for years if the choreography is precise. Tell a big, clean story. Deliver lines on time. Never pause long enough for doubt. The market, thirsty for narrative, will drink it. Analysts will build models from it. Journalists will polish its edges. And talented employees, the ones who know how to make things happen, will keep pace because pace is the point. In that world, the most dangerous thing you can do is ask for cash. When the music stops, the forensic language arrives. Criminal charges, congressional hearings, corporate reforms. Andrew Fastow would plead guilty to fraud and conspiracy, serve time, and later speak publicly about the corrosive power of incentives that reward short-term optics. Jeffrey Skilling would be convicted on multiple counts, serve more than a decade, and emerge into a different kind of spotlight. Kenneth Lay, indicted, would die before sentencing. Arthur Andersen would dissolve, its name a cautionary whisper in business schools. The buildings in Houston would still catch the afternoon sun, but the story told beneath them would change. What then are the red flags hidden in plain sight? First, profits that arrive too smoothly for too long. Real businesses breathe. They inhale and exhale with the market, with customers, with chance. When results glide upward in perfect increments, it's either a miracle or a measurement problem. Enron built a culture that disliked randomness and found a way to price it out of the picture. In the end, reality reasserted itself with a bill. Second, complexity that resists explanation. Risk management is complicated. It needn't be impenetrable. If you can't understand how a company makes money, and management cannot make you understand, what you're buying is trust, not cash flow. Enron asked the world to accept a level of abstraction that even insiders struggled to map. In the light, abstractions wilt. Third, conflicts that blur judgment. When the same advisors help design transactions and then vouch for them, when fees depend on volume rather than outcome, when careers hinge on quarterly impressions, the line between measurement and marketing thins. Enron taught a generation that reputation is not due diligence. It's an asset that can be spent. It would be comforting to place Enron in a museum of failures, bad actors, special era, unique mistakes. But the architecture of illusion is portable. You see versions of it in every bubble. Growth too perfect, narratives too clean, structures that push risk off stage. That's why Enron still matters. It maps the psychology of collective belief. It shows how intelligence, uncoupled from humility, becomes dangerous. There's a final image that lingers. In the days after the collapse, former employees walked out with cardboard boxes, family photos, a desk plant, a coffee mug with the company's logo. Outside the building, they stepped into a December light as ordinary as any other. The markets kept trading. Other companies kept promising the future. Life as it does moved on. But for everyone paying attention, something felt different. We had seen what happens when stories run faster than cash. If you're an investor or a manager, or simply someone who wants to understand how organizations win and lose, the lesson is not to distrust innovation. It's to interrogate the choreography. Follow the cash, not the adjectives. Ask why the results are so smooth. Read the footnotes as if they're the main text. And remember that the smartest people in the room are still people. Flawed, incentivized, and capable of talking themselves into a version of the truth that flatters their choices. Enron promised that energy could be traded like ideas. In the end, ideas were traded like energy: pulses and outages, surges and blackouts, illumination and sudden dark. The company didn't just fail, it taught us how failure looks when it puts on a tie and speaks in perfect sentences. For 16 years, that performance held. And then, when the world asked for cash, the curtain fell. What remains is not just a cautionary tale, but a simple standard you can carry into any room, into any pitch deck, into any set of glossy numbers. If you cannot explain it simply, you do not understand it. If you cannot track the cash, you do not own the story. And if the line always goes up, it probably isn't a line. It's a script. That's Enron, a mirage at scale. A company that made the future look inevitable right up until the moment it had to be paid for. And when the invoice arrived, it turned out the smartest guys in the room had been borrowing time.